Gaurav, we were just chatting about as to how Motilal Oswal's housing finance book has seen a very handsome jump. What is your own sense of how this segment is likely to pan out? That's HFCs.
Right. So I mean, overall, in the firm that you mentioned about, there are lots of sort of positives about that company because of which we are bullish on the name. But overall housing finance, talking about the industry as a whole, we are not as bullish on, especially the large ticket housing loan market, because we think that over the last few years you've seen this massive move up in terms of loan book growth for most of these housing finance companies because of an increase in ticket size rather than a massive increase in volumes. And given the state of the real estate in the country today, and given that we foresee that to persist, the challenges with the real estate market to persist over the foreseeable future, we think that that increase in ticket sizes that led the growth is not going to continue helping the growth going forward. And more importantly, so far we haven't seen much of stress come through in terms of housing NPAs. And again, I mean, one reason for that has been that as ticket sizes move up, as the price of the underlying asset itself moves up, even if you are a stretched sort of borrower, you could very easily refinance it, given that the underlying asset price itself is moving up. But in a scenario where the underlying asset price doesn't move up, or in fact starts coming off, is when you will see the real non-linearity or the real risk in terms of NPAs for housing finance. So overall our call on housing is negative, and as a result on housing finance companies is negative, and moreover we think it's getting a bit too crowded as a space.
Gaurav, the big move for me in trade yesterday was the way CNX IT gave a move, and this is after 3 of the top 5 numbers are out. Mid-cap IT companies haven't given bad numbers. What are your thoughts? What's the pecking order now because of the Q3 results? More importantly, the Q3 commentary that has come in from the top 3 companies as of now.
Right. So I mean, in terms of numbers, clearly, for the top 3, it has been a very mixed bag. Infosys beat us on delivering that 6.9% QOQ growth that they did. TCS about 3.94 was more or less in line with our expectation, and HCL Tech yesterday did disappoint in terms of our own estimate by about 1% or 2 percentage points lower. But I mean, if you look at it on a structural basis, I think Infosys has still not changed their annual outlook. HCL Tech on the other hand is which is that Infosys is still cautious on how the next 2 quarters will pan out. HCL Tech on the other hand has stuck to its line, and we sort of buy into that argument, which is that given that it operates into, given that the IMS offering itself is mature, and given that the deals typically tend to be large and complex in nature, the revenue from those would be typically lumpy, and as a result we aren't reading too much into this disappointment that you saw yesterday. So overall I mean, the pack as a whole has corrected quite a lot over the last few weeks, and as a result we think at these prices large cap IT is one of the most attractive segments in the market currently. So we are biased on all 3 large caps: Infosys, TCS and HCL Tech. HCL Tech is where we think, given that it trades at about 13-14 times FY17 earnings, we think the delta is going to be the maximum. And again, given its exposure to IMS and to engineering services, we think revenue growth and earnings growth are also going to be the fastest. So we think that the maximum upside is going to be delivered by HCL Tech. With that said, we expect more than 20% upsides over the next 12 months from Infosys and TCS as well. So overall positive on large cap IT at these price points.
Gaurav, I want to draw your attention to the auto universe, considering, money seems to be moving out of Maruti, getting into Tata Motors, and what a phenomenal ride Tata Motors has had all of this month. And in the meantime, when one talks about two-wheelers, it's clearly Eicher Motors as well as Hero MotoCorp, which is the top choice when it comes to the two-wheeler space. What is your own thought on how the auto sector should be approached right now, both the two-wheelers as well as three-wheelers?
Right. So I mean, clearly if you look at volume numbers and the way they have panned out over the last several months, so clearly in that sense the pecking order seems to be CVs followed by passenger vehicles followed by two-wheelers, because that's how the industry has panned out so far. But you know, I mean, talking about the specific names that you just discussed, you know, I mean, Tata Motors obviously has had a superb rally over the last couple of 2-3 weeks. But I mean, if you look at the correction that it had seen before that, I think it was much steeper than the rally that we've seen so far. So in that sense, it's still quite a distance away from its 52-week high. And you know, I mean, even after this run up, we think that the stock does offer decent value. You know, I mean, before this entire up move began on that stock, you know, almost every piece of news that came in, sort of, basically helped to tighten the bear grip on the stock. Every piece of news was being read in a negative sense, and as a result, you know, I mean, there were obviously lots of shorts built in, which would have covered in this rally. But you know, I mean, sitting where we are today, we think another 20-25% upside on the stock is easily doable over the next 12 months. And you know, the primary reason for us believing that is that, you know, to the new launches that Tata Motors has had recently in Europe, the JLR launches, the response has been relatively well in Europe, and with those products, you know, now, so it was Discover Sport and Jaguar XE, those models now going into China, we think that you know, the 30% odd decline that you've seen so far in Chinese volumes will be arrested. We are hopeful that, you know, you'll post a growth in the remaining part of this year thanks to those new launches. So overall, you know, we think that the worst is behind on the stock, and even after the rally, investors should look at any dip on the stock as a buying opportunity. We think there's still more than 20% upside to play for on the stock from a 12-month horizon point of view. On two-wheelers, you know, Hero clearly is the market leader there, no doubt about that. But you know, we think that given the increasing competitive intensity in that space, Hero does look like a franchise that's lagging behind. On scooters, it's clearly lost out to Honda, and it's clearly now losing out to TVS Motors. On motorcycle, it continues to be the market leader, but you know, given that motorcycle as a segment has been the relatively more modest performer of between motorcycles and scooters, clearly that will play out as a drag in its near-term numbers. In fact, you know, in the upcoming results, we do expect a volume decline both on a QoQ and a YoY basis on that name. Now, you know, with the stock, you know, with the way commodity prices are, there will be some positive tailwind with regards to operating margins. But overall, to the extent that, you know, the end demand doesn't revive, and given the increasing competitive intensity, we choose to be sellers on that name. At 15.5-16 times FY17 earnings, we don't think that it's still deep value. And you know, overall two-wheelers is a space that's not doing much. Within that, Hero clearly seems to be a franchise that's struggling. So we'll ideally avoid that name.
Gaurav, on a one-year basis, do you think ICICI Bank has potential to outperform HDFC Bank?
Right. I mean, you know, first of all, just to clarify our stand, we are sellers on both those names. HDFC Bank primarily because of valuation, not so much because of the quality of the bank. But ICICI Bank, we have concerns with regards to asset quality also. And you know, I mean, it's a big assumption that will the economy revive meaningfully over the next 12 months or so. We've been in that hope for the last, you know, at least 15-18 months. That hasn't really sort of played out in a big way as yet. So, you know, I won't really be taking a big call on whether the economy revives very meaningfully over the next 12 months or not. But, you know, with regards to asset quality, ICICI Bank clearly is much more stressed versus HDFC Bank, HDFC Bank being more a retail focused bank. ICICI Bank, you know, I think if I'm not wrong, it's close to 6.8-6.9% of total stress assets, including restructured and NPAs. The second distinction that I would want to sort of make between these two banks is what's happening with respect to the interest rate cycle. And you know, in so far, at least in the last cycle, you know, it seems to be you know, a given that, you know, if it's an easing cycle, banks should benefit. But I think now the banks that will benefit versus banks which will be adversely affected are, you know, need to be discriminated between, because, you know, with the way the base rate calculation is now working, and with the RBI governor now asking banks to move towards linking it to the marginal cost of funding, I think what will happen is that any bank which has, where the asset, there's a big asset liability mismatch will sort of stand to be at the receiving end of things. So between HDFC Bank and ICICI Bank, for example, ICICI Bank, the asset side is far more sort of fixed rate oriented versus the lending side, which is more sort of floating rate, which is quite a contrast to HDFC Bank, where the asset liability is more matched. So what will happen as a consequence is that is that the yields on the asset side will fall faster than they will then will your cost of funding, and as a result NIMs will get compressed for something like an ICICI Bank. So in that sense, again, I would think that HDFC Bank is a better play than ICICI Bank, just to play the interest rate revival, the decreasing interest rate cycle itself. The big call now is that does that declining interest rate cycle lead to a material improvement, A, in credit growth, and B, in asset quality? If that materializes, then obviously, given the valuations and everything, the delta would be higher for ICICI Bank. But as I said earlier, given the state of the economy, I think it will be too preemptive to take a call that the rate cuts that we've seen so far will be significant enough to move the economy, to revive credit growth, and more importantly to alleviate asset quality pressures. So net between the two, I would still stick to HDFC Bank, although again, as I said earlier, just to reiterate, our official stances on absolute terms, both those stocks are negative.
Right, Gaurav, really appreciate your time, and glad you could join us, and certainly hope to see much more of you going forward.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.